Hello everyone, welcome to the August Market Review. Now, just an overview of what we'll be going through for the 3 points today. August has been a roller coaster for equities investors as equities fell in the start of the month due to weakened economic data as well as an unwind in carry trade. That said, equities eventually rebounded at the end of the year due to strong earnings from large caps, tech stocks like Apple and Meta, as well as a high possibility of a rate cut in September, which in hindsight, we have seen that the Federal Reserve has in fact cut interest rate by 50 basis points. Dimensional equity funds underperformed the general equity index. Now that is because small cap stocks during a period of possible recession or during recession tends to underperform more stable large cap stocks. And in fact, Apple and Meta have both reported strong revenue and earnings, which resulted in their rally in August as well. At the end of the month, Jerome Powell, during the Jackson Hole Symposium, because of weaker economic data, has announced that September they are likely to do a rate cut, and that actually lead to a rally in stocks and caused the rebound which I mentioned just now. Now going into detail, at the start of the month, the US manufacturing index, which reflects the health of the manufacturing sector in the US, actually showed weaker than expected, which in fact reflects a slower economic growth. And furthermore, job payroll increase is the slowest in 3 years. Now on top of that, at the same time, the Bank of Japan was rather hawkish and raised interest rate by 25 basis points. This led to a carry trade unwind. So just to give some details, carry trade unwind is where investors generally borrow from low interest rate economies like Japan and invest in a higher yielding country, in other words, higher interest rate like US, and invest in assets like US equities and bonds. However, because of the recent increase of Japan's interest rate and leading to a higher yield, this lead to an increase in the borrowing cost for carry trade investors, as well as the weaker economic data drove equities down at the start of the month and squeeze these carry trade investors, leading them to unwind their trade, selling off their assets, and then repaying their borrowing costs in yen. Now, this selling off and on top of the weaker economic data, has led to a sharp fall in equities. However, as we enter the end of the month, Jerome Powell, the chairman, announced the possible rate cut in September, has led to a rally. And on top of that, stocks like Apple and Meta announced strong earnings, which also helped to drive the equities as well. Now, without further delay, let's go into the performance of the market index. As we can see that the MSCI World, which IMI index, which covers 99% of the developed equities market, was up by 2.42%, thanks to large cap stocks, which I mentioned, Apple and Meta, which rose 4% and 10% respectively in the month of August. And as well as we can see that the MSCI emerging market rose about 1.64%. This is because tech stocks in China has also contributed much to the MSCI EM index. Tencent, for example, broke earnings expectation and rose about 8% in August. And furthermore, because of the possibility of a rate cut in September, in India, the Nifty 50, which covers the 50 top market cap companies in India, rose about 1.5%. Now, all these actually helped drove the performance of the MSCI emerging market up by 1.64%. And we can look at the S&P 500, which rose about in line with the MSCI World IMI index. And finally, because of a weaker economic data and the possibility of a rate cut, yield has fallen and drove the Bloomberg Global Aggregate Bond Index up by 1.1%. Overall, the MSCI All Country World IMI Index, which covers 99% of the equity market, went up by about 2.34%. A very strong growth in August, despite the volatility at the start of the month. Now, moving on to the dimensional funds performance, as I mentioned just now, small cap has actually underperformed against the large cap stocks because investors sought stability during a time of uncertainty and possible recession. Now, so as you can see, the dimensional global core equity went up by 2.14% compared to the MSCI World Index, which also tracks the developed market, went up by about 2.34%. And on the other hand, the Dimensional World Equity Fund, which tracks both the emerging market and the developed world economy, went up by about 1.65%. The dimensional emerging markets also went up by about 1.47%, underperforming the MSCI emerging market by about 0.1 to 0.2%. For many investors, they are tempted to sell off their investments as the possibility of a recession increases. However, this means that when they want to re-enter, they might miss out some of the best days of the market. The slide that we are looking at here is a Russell 3000, which is a reflective of the US equity market from 1998 to 2022. Now, these investments returns we see on the bar chart is the growth of $1,000 invested in 1998 to 2022. And we can see that for the 25 period that I mentioned, investing $1,000 gets you $6,356. But if you miss the best week, you lose about more than 10%, which is a $5,304. And if you miss the best months, you lose about $1,300. And 3 months, $4,480. And finally, 6 months, $4,125. Now, hence, it is very important for investors to keep in mind that we never know when the market will, in fact, rebound and help you capture the higher return. August is a very good lesson, as we can see, for example, the S&P 500, after suffering a huge sharp drop at the start of the month, it rebounded more than 10%. Now, imagine missing those days, and how would that affect your returns in the long run? Hence, the conclusion, staying invested is the most reliable way to build your wealth over time. I would like to hand this over to my colleague, Seth, who will be doing the market debrief. Thank you.
Right, thanks Choon Siong for the market update. Right, I'm Seth, I'm a client advisor with Provident, and I'm going to take you through the market debrief. Now, if you believe in beating the market, let's take a look at some numbers. Right, the S&P 500 between 1978 to 2019, 41-year period, has done 8.7% per annum return if we just invested in there and did nothing. Now, if we remove the 50 worst days of the period, we actually jump our returns from 8.7 to 16.4% per annum. Now, the flip side is also true. If we take away the 50 best days, our returns actually drop to a pathetic 2.6% per annum return. Now, 2.6% per annum barely beats inflation, and that's something that can indeed happen if we miss the 50 best days of investing. And therefore, the question really is, do we want to risk having bad returns just for some outside returns when the annual return is actually pretty sufficient for us to reach our financial goals? Now, reacting can hurt your performance quite badly. If we take away the best day of the S&P 500, just one missed best day can have your returns drop from 9.75% to 9.39%. Now, if you miss 15 days, your returns are significantly lower at 6.28%. And of course, if you miss just 25 days, 4.72%. And since markets tend to move upwards rather than downwards, right, we will tend to miss best days more often than we miss the worst days if we try to time the market and we do it in a very ineffective manner. Now, if you look at investing in markets after markets decline by 10%, we can see that within 1 year, we will tend to get about 11.4% per annum return. In a 3-year period, we get about 10%. And in 5-year period, we get 9.6% per annum return. Now, these are very good numbers, and therefore people actually like to invest when markets decline. However, when markets are in an all-time high and we invest, you will see that returns are also pretty similar. In a 1-year period, we can get 13.7% after a market high. when markets reach a high, they tend to reach new highs because that's how markets move. They tend to trend upwards over time. Therefore, we don't actually need to time the market and wait for market declines, because as long as you have the time horizon for your assets to grow, we can expect to get good returns regardless whether or not it's market low or market high. Indeed, markets have rewarded long-term investors, as you can see from 1970 to 2020, right? Lots of downturns have happened every now and then, but in the long run, we see that markets trend upwards. So the important thing is to have time in the market instead of trying to time the market. Of course, this year is election year, and I think some investors feel that US elections have a bearing on markets, and they're waiting to see what will happen before investing. Now, as you can see throughout history, right, different presidents have come and gone, okay, be it from Republican or the Democrat parties, and we can see one thing, which is markets trend upwards. And two, it doesn't really matter which party the president is from, because again, in the long run, markets trend upwards and markets will reward disciplined investors in the long run. So the growth of the dollar will steadily compound and increase over time regardless of who the president is or which party is in power. And that's it for the market debrief. If you have any questions, ask your client advisor and they'll be happy to help.